Thank you, everyone. Thank you for this. I'm happy to go right after lunch. I think the only worst place is right before cocktails, so bear with me here. I also want to thank just the team here for putting together the event, the sponsors, and of course Tony Sirianni and the entire team. I've known Tony for about a decade when he was the founder and CEO of Washington Wealth Management. And you've been a longtime leader and visionary in the space, so thank you, Tony. I think it's a real service that you offer to the industry to shine light on all elements of what's going on in wealth right now. And this is clearly, as Tony has picked out for the name of this conference, an industry in transition. So I've been on the board of Dynasty Financial Partners and one of the co-founders for 11 years. Cheryl Penny, who many of you may know, many of you asked me how is Cheryl doing earlier. We both started our careers at Solomon Smith Barney. And in the late 90s, we were both in the private wealth management division, providing products and services to over 12,000 advisors in that company. My job consisted at that time of working with the portfolio managers and supplying separately managed accounts into our advisory network. I was constantly on the phone. I was constantly servicing advisors. And I think one of the things that I remember most about Smith Barney was its focus on the advisor. It had a very entrepreneurial feel back then, and it was, I would argue, an advisor-centric culture. Everyone from Sandy Weil down to Cheryl and myself knew that we worked for the producers of the firm. They did not work for us. The book of businesses that they had built were their clients. They were not our clients. And I think some of that has been lost lately with the focus in our industry on buying books of businesses and a focus on multiple arbitrage across our industry, but fundamentally, the industry is a service business and our focus should always be on the advisors. The economic model today remains the same as it was back then. The revenue model is driven by assets. And if we all are extremely focused on servicing advisors and building a strong platform that works for them, they will be engines of asset growth and revenues. I think the independent wealth model, specifically the RIA model, is the best one for advisors, and hence we feel strongly, and I'm going to make the case today, that all roads lead to independence, meaning RIA. I think you may find my comments are a little bit influenced by that culture that I had back at Smith Barney and that I grew up within our industry. Our belief then, when we focus on the advisors that if we focus on advisors of integrity, they are well incented to focus on growing their businesses, and the organization will be in great shape. And this is the driving force that drives Dynasty today. The mindset has led Cheryl and I back then from his garage in my apartment. We've participated in this incredible movement towards the independent space. We literally started in December of 2010 with 0 assets. The Dynasty Network now represents over $65 billion in assets and over 300 advisors. And as we stand here today, I feel the trend to independence is only accelerating. As Tony has put it out there, this is clearly an industry, as I said, in transition. I believe that transition we are seeing is the transformation from all corners of wealth, IBDs, regionals, wirehouses, and hybrids, to start to look more and more, they are all starting to look more and more like the independent advisory space. More advisory revenues, less commissions, more advisor freedom, and more choice. However, all these channels are moving toward, while all these channels are moving toward independence, none of them yet offer all that independence can provide advisors except for the RIA model. The ability to own your own ADV, own your own operating agreement, and to work for yourself. Dynasty is a pure play then in this movement and has been one of the biggest beneficiaries of this overall trend. And I will give you one perspective today as a platform service provider into the RIA space. But I think the question is, why is this the case? Why is it, what is different about the RIA model and the independent model, and why are all other models leading to this one? So I'm going to be a little bit provocative today, hopefully so that keeps the topic interesting. And while you won't agree with everything I say, hopefully you come away with some new insights that may be helpful to think about the RIA space and the trajectory of wealth overall. I am also reminded as I say this about one of Steve Jobs' sayings, which is, it's more fun to be a pirate than to be in the Navy. And in the early days of founding Dynasty, we were surrounded by entrepreneurial advisors who pushed us very hard and sincerely wanted to own their own practices. And certainly we felt like we were all pirates. But a lot has changed in the last 11 years, and now, whether an advisor decides to go independent or not, they're very aware of the different channels and no longer see the RIA route as an outlier. I think the data will show that if independence 11 years ago was a movement of pirates, and if the wirehouses were like the British Empire, the independent space is now filled with extremely large, very successful merchant vessels, and all the pirates are largely gone, and the space is increasingly being legitimized by billion-dollar breakaways on almost a weekly basis. These large teams are becoming more the norm than the outlier. And there's a tremendous opportunity for these teams after they become independent, and they can become even more successful. I think the announcement last year that Goldman Sachs is entering into the independent wealth channel and this market through custody further validates and legitimizes this movement. And their entrance will, in fact, lift all ships in the independent space. It's an exciting time to be an advisor. As an operating officer, I'd first like to start with the data to see if this is correct. The data suggests that of all the wealth channels, the independent channel has been growing the fastest over the last decade. The independent model is winning disproportionately to other channels at an accelerating rate. This morning on my way over, I saw, by the way, that Sorelli came out with their annual survey, so I'd urge everyone to take a look. It confirms a lot of the data here. I wasn't able to put it in, but you'll see it there confirmed. So on the left, you'll see as a percentage of industry advisors, RIAs, and this does not include hybrid, have gone from 19% up to 25% of total advisors. As far as assets from 2014, the projection is 30% of assets, almost a 50% increase over the last decade. At the same time, the IBD space has shrunk, going from 126 large IBDs down to just 100 in 2019. And within those IBDs, the fee-based business, more the advisory business, has increased. Commissions are down across the channel, and I think that trend will continue in those channels. The data here shows that on the left, we all are living in a very healthy industry. Over the last 10 years, we've had about 7.1% annual compounded annual growth rate of total wealth from 2010 to 2020. But it's skewed because if you look at the right, you'll see that the channels that are growing disproportionately quickly are the hybrid and independent RIA channels. So on the left, what this is saying is that on a compounded annual growth rate, assets on the left side of the channel are growing at 12% and 10% in those two channels. Where if you look on the far right, you'll see that the insurance broker-dealer, IBD, and retail bank channels and wirehouses are all down in advisors. And if you take in market appreciation, they're flat on asset appreciation. On the bottom left, you can see that total assets, as far as wealth, has gone from 10.9 trillion to over 22.7 trillion. And of that, the slice of pie that is considered RIA has increased from 19% to 25%. Final data, just to try to continue to prove this point, is where assets are coming from and where they're going. So on the right side of the chart, you'll see top 10 firms losing assets, and these are net numbers. So a lot of the wirehouses, not surprising, some of the bank channels. On the left, you'll see some of the regionals and some of the independent channels. So why? Why is this happening? And I believe that there are 4 reasons why all roads will lead to independence, and I think that is leading this data. I think it's important to understand these trends in the context of what is coming next. The 4 trends that will move this movement to independence at an accelerating rate are disruptive technologies, changing standards of client experience and expectations, changing standards of advisor experience and expectations, and more profits, not less, accruing to the advisors. Many of these trends I see as irreversible, and they will fundamentally continue to change our industry for years to come. These are almost undeniable macro market forces, just as we all use Amazon.com or Airbnb or Uber. These are new elements of wealth that are not going away, and if anything, they will only get bigger. The first is, in my mind, disruptive technologies. We are probably the last industry to see massive disruption to our model from technology. Retail, travel, print media, entertainment, manufacturing, cable, even oil and gas have all seen tremendous change. But because we are in a highly regulated industry and we have strong gatekeepers, generally we have not seen widespread adoption of disruptive technologies. It is coming. And I do not mean by technology robo. I think the robo movement over the last 3 to 5 years is almost a completely failed concept. It's not really a new movement, and I think it's generally seen at the end of a bull market cycle. Advisors will be as valuable now and in the future as they always have been. But regarding gatekeepers, when I started in the business at a large bank in a wirehouse environment, we had an extremely large IT budget and infrastructures to support millions of trades and that were running through our systems on a daily basis. We simply could not have founded Dynasty at that time because the capital requirements to start the company would have been extreme and cost prohibitive. So there were enormous barriers to entry on the technology side. But at the same time, the drawback was that before we embarked on any new technology, we'd need to get what seemed like the entire firm behind the initiative, and we'd have to get into one room to get consensus. That meant compliance, management, advisors, product, distribution, legal, procurement, and of course, all the technology teams. And it was never one meeting. We would meet like this and build something, and it might take us, say, 3 years. And the issue after 3 years and after spending $30 million is when we rolled the technology out to our advisors, they told us it was completely obsolete. The second issue that we would have is that we were very reluctant to use outside technologies. Everything was built internally and was proprietary. And banks simply have not been the innovation centers of technology over the last 10 to 15 years. There was a distrust of outside technologies and a tendency by technology leadership to favor their own in-house capabilities. Meanwhile, there has been a tremendous amount of investment in wealth tech happening outside of the bank channel. Fundamentally, this trend is accelerating, and here is why I believe that. In the first triangle that you see, you have infrastructure and mainframe and a server-based environment. On top of that, data centers, proprietary capabilities. This means slow to integrate, best of breed outside capabilities. 90 to 100% of the tech stack is proprietary, and the foundation is infrastructure heavy. Here, I think, is the new, here is the new triangle if you invert it to where we are today. Flexibility, speed to market, enhanced capabilities, they all now live in the cloud. Better, faster, cheaper. It allows for the proliferation of best of breed, better cybersecurity postures, and much better advisor and end client capabilities. In many ways, wealth is the last of the party, but it will be disrupted. Think about the capabilities again of Amazon and Uber and Airbnb and others. We fundamentally still, in our industry, have a hard time getting a good client end portal to our clients. And this is all changing very rapidly. Finally, regarding technology, I think some of the bigger institutions are looking at it still fundamentally incorrectly. They believe that technology can create efficiencies so much so that it may replace or slim down the size of advisors within their institution and increase profitability. We fundamentally disagree. In a country where you don't have enough advice, combined with demographic decline in advisors, we need more advisors now, not less. We all live in an advisor-centric world, meaning the quality of the advisor will always determine the size of the individual client assets and the total aggregate AUM, which determine all of our revenues. Technology needs to work better for the advisor, not replace the advisor. It needs to help the advisor in the following ways: be predictive, use AI, use best-of-breed technologies, extreme cybersecurity measures, and less centralization and risk. Faster, scalable, completely remote. And this is all possible in the independent space. Trend number 2, changing standards of client expectations. The only person more important in our industry than the advisor is the client. And we believe the model of the future looks more like this: the triangulation of advice. Fundamentally, the triangulation of advice refers to safe custody of assets separate from where products are manufactured and separately from where clients get their advice. Less conflicts, unlimited choice, and placing the advisor, not the institution, in the middle of the client relationship. What it means is that an advisor can go from being a professional seller of whatever it is that the bank has to offer to sitting on the same side of the table as their client's advisor and be a professional buyer of products and services across the street. 15 years ago, many of the best products were in the larger banks and wirehouse environment, but that's no longer the case. To remain essential to the end client, the advisor must have access to all of the best services and investment capabilities that are now available in the market. Clients now are demanding the best products wherever they need to be sourced from, and the independent RIA market allows for that choice. 20 years ago, as I said, the best investors may have been at the banks, but now they're at private equity firms, they're running hedge funds, they're in venture capital all over the country. The compensation model in the bank simply doesn't allow large institutions to retain the best. And where there is some of that capability in-house, it's often with perhaps a different structure that allows for autonomy and a different compensation structure. Our belief more globally is just as the best investment management talent have moved outside the bank and the brokerage environment, so too will the best wealth managers decide to move outside the banks themselves. These advisors will realize that to compete for clients, they want access to the best tools at their disposal. These advisors will realize that these are now available in the independent space. Gone are the days of compensation grids and incenting certain behavior. They will do what they need to do to get clients. Another way to think about the triangulation of advice is by taking the family office environment as it currently exists and taking it way down market. Realistically, people think about a family office so that they can have a concierge capability. They can have access to product because they're very large, and they're free of conflicts because they own the entity in which is servicing them. The independent RIA is set up very similarly in the same way. The advisor now can be an impartial advisor to the end client with as little as $3 million or $5 million or $10 million. At every point, they can act on behalf of their client, free of conflict, and that independent advisor can get products and services across the street and is not incented in any way to favor one thing over another. And the advisor's belief is that by doing this for their clients, they'll have happier clients, they'll grow their books faster and get more referrals. Trend number 3, changing standards and advisor expectations. In my daily conversations with advisors, there are several things that frustrate them more than anything else. The first is compliance, and the second is marketing, especially marketing related to clients. Clients want to be communicated to in this marketplace differently, and so cutting off innovative channels and using social media and other avenues lessens their competitiveness when they're not allowed to do it. It lessens the advisor's ability to deepen relationships and make new relationships using this very effective and efficient and scalable tool. The underlying issue is that some of these companies have gotten so big and the reputational risk to these brands have gotten so great that, as the saying goes, they need to manage risk down to the lowest common denominator. But the brunt of this business reality falls squarely on the producers who are bringing in the assets, and the assets, again, are the lifeblood of our industry. The second large frustration is constant profit maximizing motives at the larger institutions and the continued centralization of decision-making into corporate leadership. Instead of allowing decisions to be made at a local level, in a seemingly hopeless way, decisions get centralized and are being made further and further away from the action. For most conservatives in this country, there is a strong proclivity to desire decentralized decision-making, the feeling that the more consolidated, federated, centralized decision-making takes power and effectiveness and efficiency away from the local level. In many cases, because of intense profit motives and this centralization, is having a negative impact on the advisor's ability to grow. In effect, it is taking the entrepreneurial spirit out of what they do on a day-to-day basis and not allowing them to do what they know best in their local markets. Trend number 4, economics. If we believe that in the primacy of the advisor, that they have built their own book of business and the relationship with their client is theirs, it's not ours, and that we live in an advisor-centric world, then we need to stop messing around with compensation grids. Advisors that I talk to are amazed that they can make 40 to 50% more in take-home compensation than their colleagues in the employee channels. At the same time as getting a higher take-home cash compensation, RIAs that sell their practices, and we all know this well now, can get up to 6 to 12 times free cash flow on their businesses at long-term capital gains rates, not earned income, as is the case with succession inside employee channels. So these are very successful, significant benefits, and the independent channel affords over the employee model, and a huge reason why more advisors are exploring the road to independence. And as long as the economics remain that much more favorable, I think the trend will remain in place. But first, how is it possible that the independent space is more economical to the advisor than the bank channels and other employee channels? And I believe, again, that technology is fundamentally disrupting the landscape of wealth, where upstarts now have clear cost advantages over incumbent players. I think we can map out the economics in the industry as follows. In this diagram, we see that new entrants have an advantage on the cost curve as it is shifted left, meaning that if the advisory fees remain the same, the cost advantage goes to the new independent advisor. In this case, where did the excess profits go? Where does the excess profits go? Well, they go to the business. They go to the independent financial advisor, he or she that owns the RIA. So what is it? Why is it? What are the reasons that upstarts have this current cost advantage? Well, larger firms by definition have an X factor on costs. More people, more administrative controls, more real estate, more corporate, more management, more compliance. These are highly successful firms that have built out infrastructure to massively scale. It's just that they now wake up in a world that doesn't reward infrastructure the same way. The result is that the infrastructure built up over 10 or 15 years ago, or in some cases, I kid you not, 20 to 30 years ago, is not what is needed to compete in today's day and age. In an era where Tesla and Rivian have larger market caps than Ford, GM, and BMW, this is what is happening in the wealth space as technologies disrupt the traditional cost curves and infrastructure models. Finally, on economics, RIA consolidation is perhaps the largest opportunity for wealth creation in our space today. But why M&A now? Well, there are a few reasons. One, we operate in a very fragmented space with over 26,000 RIAs. Most of those are subscale, meaning they're under 100 million in AUM, and so they're not very profitable, and they won't be long-term businesses for long. Second, we're in a secular growth market. As we talked about, the independent space is growing at 10% to 12% compounded annually, makes it a very attractive market to consolidate assets. Third, we have aging demographics. The average RIA owner is in their late 50s, early 60s, and will be retiring in the next 10 years. 25% of those don't have a succession plan in their business. Fourth, the RIA market is a great free cash flowing business. Net income margins after advisor compensation can be anywhere from 25 to 35% net income. So it's a great market to attract capital and to attract consolidation. Finally, we have cheap debt and strong stock market performance behind us. All of these make it a very attractive market. Over the last 18 months, we have seen 2 SPACs and multiple PE firms from Bain and Genstar and Thomas Lee taking advantage of this fragmented M&A marketplace. As Sorelli noted in their 2020 advisor study last year, growth-challenged RIAs represent $461 billion in acquisition opportunities over the next 5 to 10 years. Let me say that again. Growth-challenged RIAs represent $461 billion in acquisition opportunities over the next 5 to 10 years. Also, from that same study, 1/3 of those advisors in the RIA channel are planning to retire within the next 10 years, and those represent $1.9 trillion in assets in play. Among those retiring, 26 are unsure of what their succession plan will be. So do you not need to be a PE firm to take advantage of this opportunity? independent RIAs can take advantage of this trend as well. Once a firm goes independent, they then have the opportunity to discuss that option with other advisors in their community, as well as consolidate the smaller players in their local markets. It's an enormous economic opportunity for business owners. Finally, I want to conclude on some of my thoughts on the meaning of the word independence. The way that I see it, there are 5 main advisor models in the marketplace right now. There are the RIA owners, the IBDs, the roll-ups and the aggregators, the regional players, and the wirehouses and the banks. But only one of the RIA owner channel confers real independence to the advisor. I say this because the wealth management industry right now, there is a lot of ambiguity over the word independence and confusion around the definition. And this confusion can lead advisors down the wrong road for a potential loss of time, money, and effort. Still, many advisors are mistakenly taking the label independent at face value, and they end up at firms that don't confer true autonomy. The easiest way to know if you're independent is if you own your own ADV. And if you own your own ADV and you're not borrowing someone else's or you're not partnering on another corporate ADV, then you're independent. If you use someone else's ADV, then ultimately they are the ones that will call the shots. The one question to ask yourself is, am I in control or not? Can you be fired? If the answer is no to the first and yes to the second, you're not independent. A truly independent advisor isn't stuck with monolithic technology or sharing another's ADV, a compliance team or management that they feel is not potentially responsive to them. Boiling down the above trends, being independent RIA is the only road that allows an advisor to take full advantage of everything that we talked about coming in the marketplace going forward. Quasi-independence will give you some of these benefits, but not all of them. So do your due diligence and find a partner that allows you to be truly independent. Finally, one of the infallible laws of economics, as Schumpeter laid out, was that of creative destruction. One of the essential facts about capitalism. And the independent space is better positioned than any other channel that I know in wealth to take advantage of the technology changes that are coming. Our size and our agility allow us to move faster and be more innovative and focus squarely on the advisors and the end client's needs. Technology, client expectations, advisor expectations, and pure economics will continue to fuel this movement. All roads are leading to independence, so make sure you're taking full advantage of all that these trends have to offer, because it is not going away, and more of your colleagues are moving in this direction. Thank you very much.